Section 21 kicks in the moment you know a client didn't comply with the revenue laws, or you spot an error or omission on a return. No can be from your own work, records you review, or a prior preparer's file you inherit. On the EA exam, they'll test the trigger words: non-compliance, error, or omission. Once you have knowledge, you have a duty. Promptly. Your required message has two parts. First, tell the client what the issue is: the non-compliance, error, or omission. Second, tell them the consequences. That means potential tax due, interest, penalties, or exposure if it's not corrected. You're not required to use scary language, but you do need to be clear enough that the client understands the risk of doing nothing. Here's the part students mix up. Section 10.1 is a duty to inform, not a duty to fix. You are not required to amend prior returns. You are not required to correct the non-compliance yourself, and you are not required to notify the IRS. On the EA exam, watch for answers that try to turn this into a whistleblower rule. It isn't. A classic example is a new client who self-prepared and claimed head of household without a qualifying dependent. You tell them it's wrong and what could happen if it stays uncorrected. Another example, you take over a practice and discover improper Section 179 deductions. Same rule, notify the client and discuss consequences. You don't have to clean up years of old returns unless you choose to take that engagement. Also, Section 10.1 isn't limited to return prep. If you're doing consulting, planning, or advisory work and you discover an error, the duty still applies. Think, you're reviewing financials for an S-Corp election question and notice unreported 1099 income from last year. You still must advise the client and explain consequences. Exam tip: if the fact pattern says advisory engagement, don't assume Section 10.21 disappears. Finally, think like a professional. Document that you advised the client. Circular 230 doesn't give a magic form, but your file should show what you found when you told the client and that you explained consequences. If the client refuses to correct it, you're generally not forced to amend or report, but you should consider whether you can continue the engagement ethically and competently going forward. Derek is an enrolled agent and also a notary and loan signing agent. Regarding his notary commission, which statement is correct? The choices include: he can't notarize any documents for tax clients, he must resign his commission, he can't notarize documents where he has a material interest in matters before the IRS, or he can notarize for clients only with written consent. Think about it. The correct answer is: Derek cannot notarize any documents in which he has a material interest in matters before the IRS. Circular 230 is targeting independence and conflicts in the IRS matter. A tempting wrong choice is the one saying he can't notarize anything for tax clients at all. That's too broad. The restriction is tied to the IRS matter and his material interest. Which action is always prohibited by Circular 230? The options include representing two clients with a conflict of interest, promoting a tax shelter to an existing client, charging contingent fees, or notarizing documents for clients the practitioner represents before the IRS. Think about it. The correct answer is notarizing documents for clients that the practitioner represents before the IRS, when the practitioner is involved in the matter or has a material interest. That's treated as an independence problem, and it's flatly prohibited in that situation. A tempting wrong answer is contingent fees, because they're often restricted, but they are not always prohibited under Circular 230.